Good morning all and welcome to today's video. I hope you are well and I hope that you had a great and a very productive weekend if you were working. So I have three pairs on watch today and those are dollar yen, Aussie Kiwi and dollar Swiss. So I'm going to break them down for you now and tell you what entries I will be looking for if they shape up from these pairs today. So on the higher time frame, my favorite of the bunch, the one which I believe is positioned the best if we just drill out, you can see that according to my data at least, we are at an all-time high with dollar yen. You can see that we've moved up to this area in a very sharp manner and we sold off in a very sharp manner, indicating that there will likely be a lot of liquidity here. I've talked previously about how the aggression with which we reached an area of value can often indicate, and how we sold off can often indicate that we will sell off again with a similar level of aggression. Of course, if we were to sell off from this area once again with a similar level of aggression, potentially it could be much easier to manage our trade if we were to look to get short from this pair today than if the previous move moved down like that. Okay, that's common sense, I would have thought. Okay, I've also just noticed that we also have, I don't think I marked this on, but we also have a near miss there. Okay, so price came down to this low here, this sharp move down, which was followed by a sharp move up, but it near missed it. Okay, when we see these, it is often the case that these near misses will be taken out, and the low that they near miss to will be taken out, because it means that there is likely still liquidity down here which wasn't tapped into, which if we take out the liquidity which is up here, once we've taken the liquidity out which is up here, this low here will likely drag price down, okay, because we failed to tap into it last time around. Okay, so these are just things that I'm factoring in. You can see we moved up here in a very non-progressive corrective manner. That also indicates that price is running out of steam, as it were, and we also have a little bit of momentum here. You can see here by this weekly candle, a bit of momentum at the end, which is often what we see when we see a corrective move up to an area of value, and then we see a bit of momentum at the end. That is often just the people getting out of their positions that caught this buy position. And this would be, if you think about it logically, this would be a good profit taking area for people who caught this move to the upside. Where do you think that they will be getting out of their positions? Many of them. Not everybody gets out their positions all at once, otherwise we would always just tank or rally from an area of value. But this would be, if I was holding this for the long term, this would be where I would be getting out. So it makes sense why we would see an exchange of liquidity once again from this area of value. Okay, you can see that we near missed to that. It's no surprise to me. Look at this bearish bearish weekly close here. Okay, we near missed to that area. Notice there's a slight gap. We came back up to fill that area, and now it appears that we're tapping into that area. Okay, so this looked like that bearish candle there, that bearish weekly, looked like a bit of a trap. This looks like a bit of a trap to me, where people saw it start to move, they fear it's going without them, and we often see that. We often see a little bit of aggression come in when there's a near miss, because people fear that the move is going without them. They attach themselves to the market. They think that the market is going without them. They think that when they take a loss, the market did it to them. So this is what happens when you attach yourself to the market. And we have to accept as traders that the market is neutral. The market is not doing it. The market is not going without you. The market didn't tag you out. The market is just doing what the market is doing. Okay. So when I see this near miss, that looked like a trap to me, and that we would likely come back up and take out this near miss. And that's exactly what's happened. There's no real structure to this that I can draw in, which is why I've not put any trend lines on there. It's just a very corrective move followed by a bit of a fake sell-off, and then we tap into the area of value. So this is really one of the most simplest trades that we could ever look for. We can see that again here, right? We have this kind of fairly corrective move all the way up, and then it looks like we may be getting, if you just look at these, we do have a bit of a bullish candle there, but generally speaking, this is quite a corrective move. And then right at the end, we see that bit of momentum coming in that I was talking about, which is often what we see at the end of a corrective move as people start to get out of their positions that caught this move to the upside. So all I'll be looking for, I did actually have this in my, so each Friday I compile a top 6 and an additional pairs list, as you can see there. Dollar yen is actually in my additional pairs just because I thought that this would take a little bit longer to reach the area of value, just because it was moving up in a corrective manner. I thought we may get a bit more of a sell off and then come back up. But this just goes to show that we as traders don't always know what the market's going to do or how quickly it's going to take. And that's why we should not, go off and do other things and think to ourselves, oh, yeah, that won't be ready for a while. I'll just go off and do other things. We don't know. We have to remain on the ball. So, which is why I've got an alert there. And I'm happy to, you know, to think to myself, okay, well, this shaped up a little bit quicker than I was anticipating. So I need to be on the ball. I shall put it in my main focus list for today because it got there a little bit quicker than I was anticipating. And so it's not about being right. So what I'll be looking for, quite simply, is for price to tap into this area of value, followed by a push down and a flag, and then I would look to get short on the break of the flag or within it. If I just drill down to the 1 hour, you can see, and then I would be able to manage this most likely down to this low here. This is not really of any significance, but if we kind of pattern separate the structures, so this is called pattern separating, you can see we have a 1, 2, a structure with 3 sections and a 1, 2, 3 middle section. So that would make sense. That's an area of significance because it's the base of this structure there. Okay, which means if this is a piece of structure in its own, then we kind of have this kind of structure here with this kind of expanding middle section, the 1, 2, 3. So that makes sense why that would be a good first target if I was to get short on the break of a flag such as this or within it, because it's the base of this little piece of structure, which is more a corrective channel, it has to be said. But you can see the structure and the middle section within it. So that would be kind of a first target. Of course, the flag we might break above. The flag might form up here. So it could do a number of things, but I'll be basically just looking for price to tap into that area of value, push down and flag. Of course, because this is such an extreme area of value, which I just showed you on the higher time frames, I've said previously that these extreme areas of value, if we just zoom out and refresh our memories, you can't even see it on the 4-hour chart. You have to zoom out to the daily. These extreme areas of values are like major train stations. And what I mean by that is that lots of people get on or off at them. So price, doesn't always just get to these areas of value and then just plummet to the downside. Often it hangs around for a while. So even if we do tap into this area, I wouldn't be surprised if we hang around for this in this area for a while before we get that push to the downside, followed by a potential flag. But as I've just said, we as traders don't know how long the market is going to take to do or not do something. So I've just got it on watch just in case we do tap into the area, push down immediately and flag. But as I say, it may hang around for a little while before this actually shapes up. So that is dollar yen. And of course, just to touch on it, the bigger target would be the first real target, solid target would be that low there. And of course, if we moved all the way down to there was some serious profit potential. And then we have this low here. And then, of course, we have the higher time frame target, which is that near miss to that low there. Okay, so that's dollar yen, just giving you my thought process. Probably one of the most simplest trades we could ever look to take. So on this pair, on Aussie Kiwi, you can see that we had a series of near misses. We near missed to there, near missed to there. We come back up, we near missed to that high. So it's likely that we will tap into the main high, which is that one, before we plummet. And if you look at this, we even have that kind of 1, 2, 3 touch structure with a 1, 2, 3 middle section. So when I see that and we tap into that area, that gives me a clue that we will likely sell off aggressively, which is exactly what happened, because that was a completed piece of structure. We also have here, we have a near miss to here, which is a negative confluence factor, which is partly why this is lower down on my list. But you can also see that you'll see this more clearly on the daily, but we have this 1, 2, 3 completed structure and a near miss here, which failed to tap into this low here. Okay, and you can see that we're well and truly in a run of momentum. It seems logical to me that the people who caught this move up got out of their positions here, and that the people who are selling now will likely get out of their positions here and more likely here because of that near miss to here. Okay, so just looking for that impulse correction continuation, and the fact that this structure is so wide relative to this move down gives me a clue that this is likely a middle section within this potential move here, right? It looks at this moment in time, this is what it's looking like to me. It's looking like this is a middle section within kind of this kind of structure to take out this high. So we would have that 1, 2, 3, potentially not take out that near miss below price here, potentially just tap into that area, move up to here to complete that 1, 2, 3, and then move down to take out this near miss to there. But obviously that's, a lot can happen. A lot of things can happen in the meantime, but that's what it's looking like to me at this moment in time. And here's the 1, 2, 3 I was talking about. We have that 1, 2, 3. Notice we near miss to that area. What normally happens when we near miss to an area of value? We normally come back up to take out the high before that longer term move to the more longer term move to the downside. And you can see here we even have that 1, 2, 3 structure leading up to it. We have no structure at all moving up, and then right at the end we have this 1, 2, 3 touch structural move. This is what we call an ending structure. A structure at the end of a move which didn't have much structure to it. Okay, that's essentially what an ending structure is. So now you can see we've had a series of impulse correction continuations. If I just drill down, you can see that price left a footprint there in the market where the liquidity is likely sat for this potential move to the downside. And you can see, I'm just looking at the sequence is pretty good. We have an impulse tight flag, impulse into a slightly larger tight flag, an impulse into a larger flag, a little tight flag on the break of this, into a slightly larger one, into a slightly smaller one on the break of this. This all makes sense. So this is a pretty decent sequence, okay? The only thing about the sequence that is not good, so it's well positioned for a move to the downside. The sequence on the lower time frames is pretty good. It's just this sequence on the higher time frames which is not so good, because we don't normally see corrections this large relative to this move down, unless, as I said, this is just a middle section within this higher time frame structure as I just broke down. So what I'll be looking for today, if we just analyze this structure and being mindful of the time, I will be looking for the following. Okay, so we got the footprint there. What do we have? We have a near miss there. We have another near miss to that area of value, which is a bullish wick. These bullish wicks often get filled. The only thing we don't really have is we don't really have any depth, okay? So what I mean by that is we're kind of squeezing into the area. That is not, in my experience, indicative of a structure that plummets to the downside. What this looks like to me is that this is just a middle section to push down to give us more depth, okay? To push up to give us that third touch, and then we would have a bit of a gap between here. Okay, when there's kind of no gap at the bottom of the structure, that implies that this is not a complete structure, which implies that we're just pushing down to give that 1, 2, 3 middle section before we tap into that area potentially and complete this 1, 2, 3. Okay, and if we do, this may not be ready by the end of the day, but if we do, I will be looking for a risk entry. So I will be looking to essentially call the top of this structure. And I will be looking for, as I've said in my text here, I'll be looking to get short with a risk entry either after a phase line break, so a trend line break on either the 1 hour or the 15-minute chart, or after a 1 hour or a 15-minute rejection from it. So because this is a larger 1 hour structure, that gives me permission, if we have a 1 hour close at this area of value, to drop down to the 15-minute chart to look for entries, but not before. Okay, so there has to be a 1 hour close at this area of value for me to drop down, and then I will look to get short, and then I will be able to manage this down to the low of this structure for something in the region of 2.5%. 10 pips is the minimum stop loss that we go to. You can see that's about 10 pips. So that's what I'm going to be looking for. I have an alert set there. If we just tap into that from where we are, then I won't be looking to place a trade. I have to see a base. I have to see a 1, 2, 3 middle section so that I know that this has enough depth for a potential rejection from here to actually play out, because then that will be a completed piece of structure. Okay, so that is Aussie Kiwi. Last on the list is dollar Swiss, another one that may not be ready by the end of the day. There's a few pairs on my top six, in my wild cards, that look like they may need 24 hours to develop. So we have a series of near misses up here. However, you can see that we broke above this weekly high and then completely smashed back below it, giving me a clue that the buyers who caught this move to the upside got out of their positions, the sellers got in, and I would anticipate the sellers getting out of their positions somewhere around here, or potentially at this low here, which price failed to near miss to last time, which price near missed to last time around, to potentially complete this structure, okay, which has a 1, 2, 3 wave middle section. Okay, so we may be coming out to take pushing down to take out that low and potentially complete this 1, 2, 3 structure, which just so happens to line up with that liquidity point there. Okay, so that is the higher time frame. I nearly said prognosis there, but analysis, and we have that 1, 2, 3, which taps into this area of value. We kind of near miss to it. We have the 1, 2, 3 middle section. We also have a pattern within a pattern, because when we drill down, okay, so I'm going to drill down, we have this within the structure that I just analyzed. We also have that 1, 2, 3. There is an inflection point there on the 1 hour chart, which and this structure also has a 1, 2, 3 middle section, giving me a clue that this is a completed piece of structure, and we push down once again. Now, if you remember on Friday, you will remember that I was looking for price to reject. So we had that 1, 2, 3, and I said that we did have this kind of 1, 2, 3. If we just within it, we kind of had that 1, 2, 3, and I think we pushed down from here. And at this moment in time, I did my last video around here. I think when price was around here, I said that I was looking for a push down followed by a 1 hour flag, which is a flag with 2 clear tops and bottoms, but 6 to 8 corrective 1 hour candles. Now, why was I specifically looking for that in this instance? The reason I was looking for that is because we'd kind of, at this point in time, we'd kind of rejected off of nothing to the left. Okay, so because the DXY looked like it was pushing higher, by waiting for 6 to 8 corrective 1 hour candles, I was mitigating the chance. And because we hadn't, as I say, rejected off of anything to the left, I was mitigating the chance of me either, let's say this was a 15-minute candle, a 15-minute flag, where we had 6 to 8 corrective 15-minute candles. I was mitigating the chance of price tagging me in, tagging me out, and then pushing up as it did. Okay, and that's exactly what price did. So by waiting for that, I save myself getting involved in a trade, which then tries to find liquidity from somewhere. Now, what was another reason why I was doing that? Another reason is because we have this little inflection point here, this little, so we have this kind of 1, 2, 3 touch structure there, okay, and then price left a footprint. We have this tight correction, and there was an exchange of liquidity here, which caused price to completely smash through the base of this previous structure. Now, why is that significant? Well, that means that this little exchange of liquidity here, there was enough of an exchange of liquidity here to cause price to completely smash through the base of this structure, which means there's likely a lot of stop loss orders there. What does that mean? That means that we may tap into that area, and if we tap into it again, we may sell off with a similar level of aggression, okay? Particularly when we near miss to it. You can see the near miss there. So this sharp pullback indicates to me that there was likely a lot of orders going in that area because of what price did last time around. This, to the bigger players, this would be potentially a high area of value for a sell. So with that in mind, what I'll be looking for today is for price to tap into this area, that area of value, followed by a push down on a flag, and then I would look to get short on the break of the flag or within it. And this time I would not be looking for a 15-minute flag. This is just kind of a corrective channel now. It's got multiple touches, 1, 2, 3, and if we pushed up there again, there would be 4 touches to some extent. So, but because we've tapped into this area of value, which price sold off from last time around, I will not be looking for a push down followed by a 1 hour flag, because we actually have an inflection point, an area of value to the left to actually work with. So if we do reject from there, it's likely that we'll sell off, and I won't need that extra little bit of insurance that I was looking for on Friday morning by way of that 1 hour flag. Okay, so tap into that area followed by a push down on a flag. No risk entries for me, because we've just been squeezing and squeezing up to this area, and because of how the DXY is positioned as well. So push down on a flag, and then I'll be look to get short on the break of the flag or within it, and that is what I'm going to be looking for today, folks. There's my alert. I hope you've taken some value from this video, and I'll see you again in the next one. Thanks for watching.